Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, CUSHMAN and Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, FRIEDMAN LLP, GEMINI Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, NEWMARK Knight Frank, Sterling and Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. So, where are we? I don't know where we're going today. You know, we're in September, sun is out, it's a nice day, business is good, that's what they tell me, but I'm a little pessimistic. I have some optimists, some pessimists. I have a variety of those type of people today. So today I'd like to introduce my distinguished group of professionals. Dr. Sam Chandon, President of Real Estate Econometrics. Joe Ficalora, Chairman of the Board, President and CEO of New York Community Bank Corp. Stephen Witkoff, Principal of the Witkoff Organization. And last, as always not least, Bruce Mosler, President and CEO of Cushman and Wakefield. So, Dr. Chandon, you know, you write these reports, you're on CNBC, you're on Fox Business, they don't want to have me, they want to have you. So what's the economist have to say about the market today?
Certainly there are indications that the economy has begun to stabilize, both in New York City and in other parts of the country.
I don't believe the beige book. That's what they said. The economy is stabilizing.
We see it in terms of business activity. You can see it in the real estate market in terms of the level of leases that are being signed in the office sector. What we also know is true is that there are still headwinds. We've got jobs that are being lost, unemployment is rising, and so we're going to have a fairly mixed recovery. We shouldn't expect that all of the different pieces of the expansion will fall into place at one time, and there's going to be a period over which it's still fairly difficult for all of us. In the real estate market, again, leasing is strong, but transaction activity is still fairly slow.
Wait a second. I really want to hear about, is leasing strong, or are people coming to visit, and are they signing the leases, or are they looking?
Oh no, I think what Sam said before is absolutely accurate. There are people, because we've seen 30 to 40% value deterioration, that are absolutely committing to leases and on a long-term basis. I think that it would be incorrect to say that what we're seeing is positive absorption. We are still seeing net negative absorption, but people are committing. There is activity taking place and transactions being done. And when I look at the current activity versus where we were first quarter of this year, we are in a substantially better place in terms of businesses that are committing and are able to commit to long-term deals.
Now, I have a question. So if you're a landlord, okay, you're not a landlord. He's the only landlord over here. You're a landlord, and somebody wants to sign a lease, and they say to you, because it's going to cost more money, I want $1 million for the tenant improvements. I need 9 months free rent. Where are you getting the money, Stevie?
We're writing a check.
What happens if you aren't a strong person?
Then I think you got an issue. And that's the disconnect out there, but you really have to understand that. You have to understand that's an important due diligence item to understand why, you know, why people can't fund into new deals today.
Now, I'm not talking buying new deals. I'm talking about the situation. You know, here's a banker who's a major player in the market, and you know, let's say, and I'll ask you the question. You've done some buildings to some good established developers, and now some of these buildings You know, they were, in 2006, 2007, they were bought for the simple reason that they had a lot of vacancy because they felt that the rents would go up over there. If that developer came to you and said, I need another $5 or $10 million to fund tenant improvements, would your bank lend the money today?
Well, it depends on the circumstances. Obviously, if he needs another $5 million to do tenant improvements, something went wrong with the original financing because he should have had enough money to do the improvements. But if in fact the property has changed from the standpoint of its capacity to carry, it's harder to carry more money with less money. So
we're in a catch-20.
Absolutely. There's no escaping the fact that I guess Greenspan said earlier this year, and this was very early in the year, from 2007 through the beginning of 2009, $40 trillion of world wealth has been lost.
That's right.
When you lose $40 trillion of world wealth, you lose volume of dollars to be spent. And that's on everything. And the major problem we face within the New York market is the fact that a great deal of the money that funded the appreciation in values, and most of the appreciation was driven by the availability of funding,
Absolutely.
isn't there. So now, absent the availability of the same level of funding, values will come down. So there's an adjustment period. And you know, people may make judgments that adjustment is sufficient for me to carry over time, and that could work. But people that have to readjust within the next 4-8 quarters are going to find that they're not going to get funding for the levels that they had before. If you're buying new and you're buying at a discount, that's different. But
even then, to your point, the loan to values will be different.
That's right.
And so the cap rates will be different, and that
That's
may
true.
be a more permanent sort of outcome.
Well, that has a
from this
longer
past cycle.
adverse effect.
Absolutely.
I just want to bring up just one small point, though. Let's assume I owned an office building. I didn't have the $5 million to put into the under Michael's hypothetical. I had a tenant in there, and the tenant was willing to extend for 10 years. Correct. You came to me representing the tenant. You said, Steve, you can extend this lease for 10 years. Smart deal to do. You got to give the tenant $5 million in something. Tenant installation work, free rent, something. It's a credit tenant, makes some sense. It's one thing, I don't have the money. It's one thing going to see my banker who's got the loan in his balance sheet, Joe Ficalora, and saying, listen, Joe, I don't have the money.
Right.
You know, whatever it is, I don't have it, but I have this great opportunity to make the security of this building better, to enhance its value on the long term. And now he and his committee get to make that decision. So that's one scenario. Now here's the second scenario. My deal is financed in a CMBS. I've got a special servicer and a master servicer. The trust agreement says that there are no funds allowed to be released out of the cash flow of the building. Everything gets trapped and goes to the bondholders unless I meet a loan-to-value test. Today's appraisal on that building makes it that I can't meet the loan-to-value test. I call the special servicer in Oshkosh, Wisconsin. He says to me, I'm sorry, you know, read paragraph 2, little I, no can do. That's what's also going on out there today. So, you know, there are at the margin these situations, and you really need to understand it before you can evaluate real estate.
Right.
Steve, I think, made a very, very important point. In the market today, if you're not doing your due diligence, then you are without a doubt spinning wheels, because there are landlords, there are REITs that are fully capable of playing in this particular marketplace and taking advantage of the marketplace to take disproportional market share from those landlords that simply aren't in a position, don't have the capacity to write that check, and or are in current limbo. There is a little bit of a divide. We've talked about this in the past, Michael, where there's, you know, certainly going to be in this marketplace a trade up for those companies that are able to. And just as there is that divide with companies who will move to a better class of building, there are going to be landlords that have more problems to overcome versus those that can be aggressive in this marketplace to pursue tenants.
You know, you bring up something. A couple of months ago, Steve Witkoff was on the show with Steve Siegel. And Steve Siegel, being, in addition to being at CBRE, is a very large owner of residential apartments. Now, at one time, Steve Witkoff, was a young attorney, a Dreyer and Traub, and he went into the apartment building business, probably borrowed from New York Community Bank. No question he borrowed from New York Community Bank. But you were saying at that show that the people in the outer boroughs, because of the recession, because of the economy, many of these people cannot pay these rents. Let's discuss that, because that relates to rents in the city, to what's happening in the economy, and also to borrowers that you may have lent money to on these buildings in the Bronx.
Yeah, none of those buildings, when they were financed, we said it all along. When we were buying, when Larry and I began buying in the late 80s and in the early 90s, I want to say that we owned a portfolio of 7,000 apartments in Washington Heights, Inwood, the Northwest Bronx, including Manhattan. Forget it. We weren't using then price per square foot as a metric. We were using a gross multiplier of the rent roll. I would tell you that the average price we own that entire portfolio at was 2.5 to 3 times on a gross multiplier basis of the rent roll. That's incredible, right? When you think about it, and we were barely making cash flow then. Why? Because we were responsible landlords, and we were putting money back into the buildings.
So let's fast forward.
You haven't lived until you've seen 20%.
Now, let's talk about now.
Now, but in 91, 92, that portfolio was experiencing 20% credit loss. Forget about vacancy. I mean, credit loss. Like, tenant can't pay, and by the way, I can't blame them for not paying. I mean, if I have a tenant, and we were really good people, we had an impeccable reputation. And why? Because we understood. Not like we were sensitive, but we understood. Why would a tenant pay us rent if the choice is they lost their job, and the choice is pay us rent or put food on the table, or I mean, these are working class people living from check to check, and you know what? It's happening out there today.
That's what I'm saying today. It is happening out there today.
Well, but you've got a big issue out in the boroughs. I said this 6 months ago. Huge issue. We always predicted there was going to be massive credit loss out there. Massive. I would imagine if you go down to Housing Court in 111 Center Street, where I used to spend a lot of time, and it could really chasten you going down there, because you walk in as a landlord and you're determined to get your money because you think you're operating your property responsibly, and then you meet the tenant and you listen to all of these issues that these people have, and that's what's going on out there. And if I was a housing court judge, you know what? I'm not sure that I think I'd be just as lenient as they are down in housing court. So it's a tough situation out there.
So how do you lend today to multifamily? I mean, it's probably the best asset to lend on, but how do you lend in case there is this credit problem and people aren't paying their rents? And Zuckerman the week before said that unemployment really is probably over 16 to 18%, right?
In essence, you have to lend to the best owners. The reason we haven't had a loss in our multifamily product for 30 years is because the people that we lend to don't lose money on their properties.
Well, they stand behind it.
Right. Yeah. They hold their property. They have the capacity to hold their property through the cycle. Cycles are inevitable, and this cycle is going to be difficult. So
but you didn't overlend either, Joe.
That's right.
I mean, you can't, right?
So when you look at the degree to which we lessened our lending, we were refinancing 32% of our portfolio in 2006. In 91 or 92, we were refinancing 92% of our portfolio, and we were increasing our lending at the same time. So the reality is the best owners were selling in 6 and 7. And certainly they, in fact, will be...
Very important point.
Yeah.
The best owners, the smarter owners said, let me take my money, get off the table. If somebody wanted to pay me X dollars,
right,
which were many of the real estate investment funds,
right,
and this is the situation that is coming to haunt some of the funds who have made investments in Rivington or other places,
right,
or Peter Cooper Village and Stuyvesant Town, and this is the problem.
We had Riverton at $11 million in 2005. When it defaulted, it had $225 plus a 25 mezz piece behind it.
Right.
So the differential isn't covered anywhere close by the cash flow. But the reality is it's a good property and has a good cash flow, and with the right owner, it's a good loan.
Yeah, and Larry's a good operator, by the way.
But
I mean, he is.
I think
you can't...
At the root of this is when you look at the outer boroughs, and when you, even coming back to the old dynamic of midtown, downtown, and what drives downtown, it's a healthy midtown. What drives a healthy outer borough to a very large extent is a healthy core,
Yes.
meaning Manhattan. So when the core is ill, as it is today, everything in the outer boroughs, there's a multiplier effect in terms of the impact. And that's why if it was 20% bad credit back then, today it's likely to be 40.
No, I don't think so.
No?
I actually think it goes back to what we were talking about before, because and what we were talking about in the room before. The city's a nicer place to live, Bruce. Back then, there were squeegee guys on the street. If you made a right on 96th Street, you know, you couldn't, the crime rate was out of control. New York City was really a very
Oh, no, I
unpleasant place
agree
in
with you,
the
Steve,
90s.
on that. My point is that in terms of the credit defaults, it's going to be greater in the outer boroughs. The working class person has been hit harder to a certain degree. And
Right, but when I'm
is
talking
under
about the
more
credit
duress.
loss in the 90s that we
You're talking about
experienced,
on the-
it was out of boroughs. It was out of borough credit loss.
This reflects a huge degree of uncertainty that all of us face, I think, in the New York market, in that you're absolutely right. We depend upon a strong financial services sector driving outcomes in Manhattan to generate spillovers into the other boroughs and into employment and adjacencies. And right now, one of the questions that I think we still face is, well, what will the financial services landscape look like over the next couple of years?
Normalized.
Will it? Hopefully, it will normalize, and hopefully, the kinds of limitations that we hear discussed around how the financial services sector will be allowed to operate, some of that will take a form that is not quite as restrictive as some of the discourse would suggest at this point, because that could present a new set of challenges for New York in terms of the capacity of financial services to once again become that real driver of economic activity here.
No question.
Relating to that, in the mid-90s, it was the best time for certain people to buy properties. You got great deals on properties, you got great deals on notes, and then the banks were conservative. They were doing loans at 40% of value. They were requiring. So, will they repeat itself? Will it be like the Michael Douglas? They're having a revival of Wall Street this year, the movie Wall Street, and its 20th anniversary. Greed is good. I mean, are we going to have the Lehman Brothers? Are we going to have new entities? Are we going to have collateralized mortgages again? I mean, where do we see? I know that in next month that some REITs are going to have some type of CMBS over there.
No question.
So what do you see happening?
Well, I think that in the securitized market, certainly there have been a couple of moves that, while not steps that will act to alleviate all of the problems for the market, are slowly working to alleviate some of the stresses. And so we do expect the first new CMBS deal in October. We know that just this week the Treasury and the IRS relaxed some of the rules that would impose tax penalties in cases of modifications for CMBS. These are little by little important steps. Where I think we face some of the more significant challenges is that none of the policies that we've seen promulgated thus far have really targeted the potential for distress on the balance sheets of banks. And where we do have cases where there will be defaults, where we don't have operators that are quite as talented as is really called for in a challenging marketplace like we have now, we do need, I think, potentially some policy intervention to alleviate those stresses.
What about, I mean, I read in the press that you are looking for distressed debt. I mean, what do you see out there? Is there distressed debt?
No, there's not. And in answer
So that's,
and in answer to your question, is it going to be a redo of the 90s? No. If you want to buy distressed today, you have to buy distressed CMBS bonds. And I will tell you, that is we do it, and it is one super complicated business.
Forget the distressed CMBS. I mean, I was at a seminar yesterday, and they asked 4 people, some of them in the investment banking place, some of them used to be with Wachovia. They said, if you were a borrower and you had an opportunity to deal with a collateralized mortgage lender or an equity shop or a balance sheet lender or a life company, who would you like to deal with? Everybody said one place, the bank. We want to deal with somebody, as you said before, that you don't have to deal in Indianapolis or Omaha with a CMBS who said, I don't really care about this. I don't know what's going on. But my question is, and I brought this question up to Joe earlier in the day, have banks come to the cognizant point that they should sell some of the loans, which are bad loans, to people? Should they go into the market? Are you seeing that happening? Joe?
It hasn't been happening in the New York market to any great degree yet.
Do you see it happening in the New York market?
Is it conceivable down the road? Yes. But it's not something that's happening today. And I think that the point that you made is very valid. A lot of what's going on today reflects this cycle. And unless we make the distinctions between this cycle and the last one, we're going to miss the reality. The source of funding over the last 10 years has greatly differed from the source of funding. So the complexity of dealing with unraveling is going to be very, very different. And the timing of the events and the consequences, this change is a more elongated process and a more complicated process. So values will be affected over a longer period of time. There'll be isolated circumstances where you can get a good deal and you can get a good property, but there's going to be significant numbers of properties that are going to be complicated by the absence of certainty as to how do you resolve.
You know, Joe, we're looking at, we own a position in a CMBS deal. We bought some bonds in the CMBS. It's a CMBS that was done in late 2006, 2007. 40 separate properties in it. Hotels, multifamily, some land. You got to underwrite it all. You have to know who's active in the bondholder group, who's not, who the seller servicer is, how sophisticated they are. Seller servicers are allowed to extend for 2 years, almost as of right. So what is that do to your level of return? It is very complicated business. Back in the 90s, Michael, the source of financing, right? In 2006, I think they did $280 billion at CMBS that year. That's where a lot of the funding was coming from. In the 90s, there was no CMBS market. So when all these banks had problems, the RTC took them over, and then they sold these loans out.
You know,
you can't. They're not reselling.
You know, Steve, you bring up a good point. Do you see an RTC type of mechanism coming back?
It doesn't exist today. It would be favorable. However, what you're talking about is uncertainty over time. Resolving those issues will take more time than the market really can appropriately adjust to. You know, properties aren't going to change hands. RTC moved property at deep discount rapidly. That's what they did. They dumped assets into the market, and when the market was prepared to absorb.
I think what they did is, I don't want to put it on a healthcare situation, they said, hey, we have a cancer. Let's cut the cancer and get rid of it. Right now, that's not happening. I hear that with the government programs. I hear that in general.
But if you look at the data from the banks, what's very clear is that the number of modifications, extensions on existing debt on the balance sheets of the banks far outnumbers any new commitments that the banks are making. And in part, it's because with such a thin market, with uncertainty around pricing, the incentive is to delay what is potentially very inevitable.
Well, it's tough to unravel those structures.
I think that's really the crux of the issue. That it is much more complex this time around.
Yeah,
it's not a single source that you can go to. It's not your community bank. It's more complex. It's going to take more time to unravel. One of the fundamental issues is, will the marketplace, in terms of the fair market value, catch up in that in-between time, and who's going to be left owning the asset at that point?
I mean, Bruce, ask Joe what happens every single time he gets repaid on a loan. If he gets repaid $20 million on a loan, I would imagine that he gets on the megaphone and he tells the entire lending group in New York community, no, we got $20 million in new firepower to lend into a more depressed market.
That's what he's saying.
But you know what? If the CMBS takes time to unravel, then all those bondholders, who, by the way, make a business of buying this stuff, insurance companies and so forth, they're locked in. They don't have allocations to buy. If you could pay them off, they'd start buying again. And this is what's going on, and so it's going to take some time.
I have a quick question. 1992, 1993, people were buying, you bought buildings, you bought 156 William Street, maybe for $80 a foot or $50
No, $15 a foot.
$15 a foot. The building, the building traded for about $400 a foot. Now, maybe it's worth $150 a foot. Do you see, within the next 2 to 3 years, do you see buildings ever going back to $1,555 a foot, like 450 Park Avenue?
It's a difficult question to answer, Michael. I'm not trying.
I didn't want to make it easy.
No, I'm not trying to politic the answer, but I think. To some degree,
Bruce,
it's going to
don't be evasive. Yes or no?
I am not going to be evasive.
Well, you think the Woolworth building is going to go back to that value, don't you, Bruce?
Stevens building is going to go back to that value. I think that you have to look at it by asset class. Will A buildings go back
Bruce,
to
I think you're 100% right. A buildings are a certain category.
But can I ask Bruce a question along those lines?
Of course.
Tell the audience what happened in, let's say, 1995, 1996, when everybody thought New York City, downtown was, and because that's a microcosm of what we're talking about,
Sure.
was going to recede into the river, and the Alabama Bonner and the pension fund leased up that space to S&P. It ignited the market. No, and those things happen in this town.
We won't name.
Am I right?
You're absolutely right. We won't name the specific building on Water Street, but the answer is that deal alone certainly sparked it. It's going to take an investor, a Sam Zell type of investor, who makes a bold move, and the perception in the marketplace will change dramatically. As much as we talk about the numbers,
could that be an Italian investor?
It could be. But the point is, perception here, and when you see a market term, all the econometrics aside,
It's very behavioral.
When it is behavioral. So
Right.
when you see those things take place, and I think New York is the type of city where we'll see it first. And I don't discount London either, by the way. As much as we said New York and London, New York has sort of eclipsed London. I'm not so sure. These are two of the most important world financial centers. But New York,
But we got it over them. We got it
over
over them in our city government, though. Now we actually have a very stable city government.
To the government.
Pardon me?
We're not talking about the government.
No, I know, but I know you want to talk about that, Bruce.
I do.
I know,
And we do have a
I
stable
know you
city
want to get
government.
right out front.
Wait,
on this.
we
I
have to
do.
let Sam get his last comment then. Okay.
So aside from the issue of jobs, we want to see a return to robust job growth, driving the fundamentals in the city. That's going to be critical to value. But the other piece of it, we do have good government. We have to be very careful. We've seen other cities like Philadelphia right now, which is facing the potential for a real fiscal crisis. One of the mistakes we don't want to make here is to raise taxes in a way that might drive people out of the city, whether it be businesses or individuals.
Since we're not
Primarily business.
Okay. I would like to thank my four guests today, Dr. Sam Chandon, Joe Ficalora, Steve Witkoff, and Bruce Mosley. Next week, we have the bankers to say, oh, show me the money. See you next week.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, CUSHMAN and Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, FRIEDMAN LLP, GEMINI Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, NEWMARK Knight Frank, Sterling and Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.